It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the program. And with me in the studio today, CFP Josh Gregory and CFP CPA Ryan Fair.
Yeah, good to be with you guys. Well, taxes get pretty confusing when your dependent children get jobs and start earning income. Can you claim them? Do they need to file their own return? How does all that work? Today, we're going to be joined by, as Mike said, Ryan Fair, CPA, and a regular guest here on the show to answer those questions and the issues surrounding it.
Glorious. This is a glorious day when these kids start pulling their weight. Ryan, seriously, how old how old does someone need to be in order to get a job? I've got Easton's 3.
I was going to say, my kids are 8 and 10, and I'm ready for them to go.
Yeah.
So get
your
out
kids
there, kids.
could be doing a modeling career by now.
I don't know about that.
That's how they could earn some
Mama could.
cash.
Hey, if you have questions, we'd love to hear from you. You can engage with the Wise Money Show several different ways. Call or text 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com. And then all over social media, that's where most questions come. Just search the Wise Money Show. Wherever you're at, YouTube, Facebook, Twitter, search the Wise Money Show. Engage with us there. Yeah, I'm not kidding. So the kids are asking for chores, and they're asking for how can they earn money. 11, 9, and 3. I think, 14? How old do you need to be to actually get a job? Or is there an age limit?
I think it's 14.
That's what I've always said. Unless it's maybe working for a family business or something.
Right. But typically, we get this question, I would say, a dozen times a year, where it's, hey, my child got a job this year. Do they need to file their tax return? Or, well, they made too much money. Can I still claim them? I even got this question from a fan of the show. My 18-year-old daughter is earning more money than I am. Do I still get to claim them? And so Ryan's going to help us understand all of those questions and the various scenarios. So glad to have you here, Ryan. Let's start with the basic. Let's start with the easy one, and then we'll get more complicated. My child's working, but they're not making much money. At what income threshold? How much do they need to make where they've got to file a return?
Yeah, this is, like you said, the basic, easy starter question, and it's not, unfortunately, a basic, easy answer because every state is different, and, of course, the IRS is involved. On the federal side, it's actually very easy. So each child or each person that files a tax return can take a full standard deduction, which for 2021, that amounts to $12,550.
So even if they're a dependent of someone else and they're going to be claimed by someone else, if they file their own tax return, they get a full standard deduction.
Correct. So so that's the answer for the federal return. They don't need to file if they're over unless they're over $12,550. But these states throw in a curveball. So Indiana,
let me guess, Indiana has a deduction of $12,850 as well.
Nice try. It's $1,000.
Oh, is that right?
Yeah, real close. So yeah, any earnings over $1,000 in Indiana, you're supposed to file a tax return. Yeah. So Michigan, obviously we deal with a lot of Michigan folks around here too. Their exemption is quite a bit higher. It's $4,900. Okay. So beyond those limits, you're required to file. Under that, you're not necessarily required to file, but that's where you got to look at the W-2 or pay stub and see if there's actual federal withholdings. If there are withholdings, you'll want to file to get those withholdings back.
Yeah, that's often the answer to a lot of our clients' questions. It's, do you need to file? Maybe the answer is no, depending on the income level. But then you have to turn your attention to that W-2 and say, maybe you've been paying some taxes along the way, or your son or daughter has, and you're going to get it all back if you just go file the return.
Yep.
So
okay, so the scenario is child, college-age student is full-time at school, worked this summer, made $4,000, working a little bit at college, making another $1,000, so maybe make $5,000. They're a full-time student, so they're a dependent.
Yep.
Okay. But then they file their own return.
Yep.
And if it's in Indiana, federally there's no tax, but they should file a return. They're going to need to file a return to get to the Indiana.
Oh, yeah, to get the Indiana. Yeah, because Indiana starts with the federal adjusted gross income. That's the first line on the Indiana tax return. So, yeah, you still have to end up doing the federal return to get to the starting point for Indiana.
And they're likely going to withhold a little bit federally anyway.
Right.
Is there anything the child can do to make sure there's no tax withholdings, or would you say, no, that's playing with fire?
Well, yeah, no, they definitely can. I mean, if in that situation, if you know the kid's only going to earn $5,000 for the year, and they can, when they sign up or get employed, fill out the W-4, they can show they're exempt from withholdings or no withholdings.
Yeah.
And then if the payroll department, follows that, then...
Here's what concerns me, though. Like, you don't want to get them started on that habit.
Yeah,
I remember
exactly.
I was a busboy. My first job, simple days. And I was a busboy, and then I also worked at, they used to have these things called videos. Movies.
Man,
where
old.
you could go to a video store and rent movies. And so I worked as a busboy, and then I worked as a cashier, basically. And so part of, even though I didn't learn anything in either of those jobs that would be applicable today in my career, learning a W-4, how paychecks work, how tax withholdings work, learning to hustle and learning to talk to adults. I mean, I learned those things. And so I would be careful about setting the precedent to your kid that, no, don't withhold any taxes. You'll be fine.
Yep.
So
No
anyway.
doubt. Well, that's like the highlight of my nephew's year, too. I file his tax return. He's a sophomore in college at Purdue now. And, like, he made good money in the summer, made a good chunk of change, but he's getting this refund, and it's like Christmas. And
It is. It's like a forced form of savings in a way, I guess.
Were you going to say Christmas in July? So you extend him every year? Is that what you're saying?
He's the last return
He's
you
waiting
get
on this
to.
money.
Family
Uncle
treatment.
Ryan, I got it. Please, I want to buy. I don't know. Anyway, okay. So what about that college student who's not a full-time student? Okay. So what? Same scenario. They're living at home. Maybe they're taking a class. We don't have a cough button in here.
Yeah, sorry.
And they make $5,000. Like,
Right.
are they a dependent? How does that work?
That's a whole different situation. So if the child is not a full-time student, then
So 18 or older or over 18? How does that work?
over 18.
Okay.
So once they're normal dependent rules are as long as you're under age 19, you can claim the kid as a dependent. Once they're under age 24, but over age 18, so 19 to 23, if they're not a full-time student, all of the dependency rules change. So then they're only allowed to have earnings of up to $4,350 to be considered a dependent if they're not a full-time student. So full-time student is a whole different, can of worms that they can earn, 10, 12, 15, whatever. There's not a magic number. We're going to talk about that soon.
we're gonna get into this.
Yep.
I mean, how does someone keep that straight? That 4,300 number. I'm just gonna tell you, I'm a numbers person. I'm gonna forget that.
Yeah. So basically, what you're describing is, if you're no longer a full-time student, it's almost presumed that you are not a dependent anymore, unless you can keep your income really, really low. 4,300, you said.
That's correct.
So, yeah, if a child is taking a gap year, like between high school and college or something, you could get caught in there somewhere. That's something that parents really need to take note of, and high school students need to hear that loud and clear. Being a full-time student affords you a certain amount of almost protection underneath the tax code.
Yeah.
Yep.
And so for those of you that have, college students right now and they're having a great semester, fantastic, they're full-time students. But this is the other thing where you get into a semester and the child's like, okay, this is not working. I'm taking too many courses. I need to back down, or I'm having some life issues. And so you just got to be aware of this. I've got a whole list of other questions that we're going to pepper Ryan with. That and more coming up on the Wise Money Show with Korhorn Financial Group.
Holy cow.
Hello, YouTube. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. Right here at this channel, make sure you hit that subscribe button, turn on notifications, smash that thumbs up button, because every Saturday at 10 a.m., we have a new episode that airs right here, also on podcast as well if you listen to that. But a full 1 hour talk show airs right here every Saturday at 10 a.m. All throughout the work week, we've got Next Wise Step videos, what we call them, but they're shorter, 8, 10, 12 minutes, taking one financial concept, applying it directly to your financial life. So if you're trying to learn about different strategies, different ideas, fringe approaches to your financial life, so that you can make progress, get ahead, achieve your financial goals. If that sounds like you, make sure you hit that subscribe button, turn on notifications. If you like the content, like the content. All right, good stuff.
Get your hairball out there.
I don't know, man. I'm dying, I think. Lindsay, you got any mints over there?
Mints?
Something to...
I can give you a piece of gum.
I think I have one of the...
Throw me one.
I want to keep going on this stuff because let's answer that question. Okay, now my child is making more than me.
Yeah.
What is it? My 18-year-old daughter. So we'll presume that they're well, it doesn't matter. We'll presume that they're a dependent.
Yeah.
So, all right, and we're gonna need to hustle.
I'm sorry.
That's all right.
Here.
She's got it now.
Okay.
Thank you.
Those things are so big, though.
I know. I'll try not to clink it around.
Yeah, you will. It's all right.
Crunching it in your mouth.
I won't. I don't crunch it anyways.
Layman's mints.
All right, here we go. How's it work when your dependent kids start working? How's it work for their taxes? Do they need to file? Are they still a dependent? If they're a dependent, do they lose out on something? If they file their own return, do you lose out on something? We're answering all those questions right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFG studios, Joshua Gregory, and then CPA special guest Ryan Fair. Make sure you catch every episode on podcast. If you're into that, wherever you listen, search the Wise Money Show and subscribe or follow us there. And when you do so, rate the program. We appreciate it. All right, so we're into this topic of you've got typically dependent kids, or you've got young kids, young adults that start working. How does it work on your taxes? We've answered some of the basic questions, but here's a question from the fan of the show. The fan of the show. A fan of the show. We have more than one. We have two. My 18-year-old daughter is making more money than I am. Can I still claim them? Can I still claim them as a dependent?
It depends.
Okay.
So that's the answer to everything you ever asked me, Mike, but it depends. So typically, my first initial gut response would be no. So the IRS has a whole set of rules about support. In order to claim someone else as a dependent, you have to provide over half of their support. So the IRS has a bunch of worksheets that you can go through to figure out, did I provide over half their support? So obviously there's a value to housing, all of the utilities, all of that stuff. So you go through and add all of those costs up between your mortgage, utilities, property taxes, all that stuff. Divide it by the number of people in the household. So that chunk goes into support. All of the dependent or potential dependents, other expenses that are, necessary, clothing, food, all of that stuff also gets added to that amount. And then you have to figure out who provided over half the support. If the kid is actually making more than the parents, chances are they're not the one providing over half the support.
What if the kid's just banking it? What if they're just saving it up and so they're like, I'm not providing my support. I'm keeping it.
Yes, that's the wild card exception that you
really?
Yes.
Oh, I thought you were going to clamp that down and say no dice.
No,
Ryan, we just had that conversation the other day, and you were describing that if you could prove like what was their bank account balance at the beginning of the year versus the end of the year, and show that they're earning all this money, but they're saving it, not spending it on their own care, then you have a leg to stand on now to prove to the IRS, nope, she or he qualifies.
Yeah. So it's pretty crazy, but we do have a couple of those situations where every year the kid makes a bunch of money from either investment income, which again that's a whole different can.
Well, we're going to get into that in just a second.
Yeah, or there could be child modeling or child acting, those kinds of situations where the kid's making a ton of money, but if they're not using it for their support and the parents are still providing over half the support, the parents can still claim them.
Mm-hmm. My son came to me the other day and said, "Dad, will you take a picture of this banana? I'm going to sell it on Craigslist. He heard from a teacher at school that someone took a picture of a banana and sold it for like 120 grand. And
Oh my gosh.
he thinks he's found
Sounds like
his
an NFT situation.
I
don't know.
was gonna say, like, I saw this meme the other day where it had like a picture of a hat, and it was a hat that was being sold at the store. You know, $19.99, and so and then it said a picture of a hat as an NFT was $50,000 or something like that,
crazy.
which is so ridiculous. Anyway. I want to get into that too, because kids are making money these days.
Yeah.
That stuff, trading meme stocks, and then college athletes. We're going to get into that here in just a little bit. But, okay, so it's half the support. What if they're a full-time student and they're making all this money? Is that still half of the support?
Yep. Still need
Okay.
required to parents or whoever's claiming them is required to provide over half the support.
Okay, so now let's get into this part where, all right, I've heard those rules and my child's going to land in one camp or another. Do they win? Do I lose? Do I win and they lose? Like, how does that work if, say, a child's a dependent, you're dependent, but they make enough or whatever, they're going to file their own return.
Yeah.
Do they miss out on something because I'm still claiming them?
Not really. So the standard deduction, as I said earlier, still applies to the child. So they can still take that $12,000 deduction from income and not pay any tax. So that doesn't hurt them. There are no exemptions anymore, like prior years where you would lose an exemption if someone else was claiming you, but that's not an issue.
That's the part that's confusing to a lot of folks, because you could get lost in some of this jargon on standard deductions versus itemized deductions and the old exemptions that aren't even around anymore, at least not at the federal level.
Right.
But they are at the state and so on. So you keep referring to this as an issue related to the standard deduction.
Yeah.
And I almost feel like we should pause and just define what that is, remind people of what it is. A standard deduction is a write-off that you get just for being you, right?
Yep.
Either as an individual or as a married couple. And if you're a married couple, it's literally double what it is for an individual. And this is something that the government's offering you as a write-off unless you can go build your own by itemizing your deductions, writing off things like some medical expenses, some of the state and local taxes you've paid, your real estate taxes, mortgage interest, charitable giving. Though that's a relatively short list, and it's harder and harder for people to even be able to itemize and use a better write-off. Most people are using standard, and that's why we're talking about this so much.
Yep.
Is do you get to take a standard deduction? Do you have to file a return? It's why it's become an issue for a lot of people.
Yep, for sure. And it's gone up significantly. I mean, that was part of the Trump tax plan. They basically doubled the standard deduction a couple of years ago. And so it's a big deal, big write-off.
And all these discussions about, we're going to have you on. Well, Ryan's going to be back on the program next week talking about the other typical topic, and that is I sold my house. Is it taxable? But later in the fall, there's all this stuff going on with tax law, potential tax law changes. We're going to let Congress sort some of that out. We're going to bring you back on the program. You're going to explain all that. But is there any rumor right now that standard deductions are changing with some of these tax laws?
Yeah, time will tell. I don't know.
Okay.
I don't know. I don't think so.
Yeah.
But everybody's changed. I mean, Congress is just in the mood to change stuff, and so that's what they do best with tax law.
Okay. So now let's go to the other scenario where my child is claiming themselves. They, for whatever reason, they're claiming themselves. Now, then, do I, as a parent, lose out on something?
Yeah. So you could, and so the way that works is if the child, well, first of all, the child can't claim themselves if the parent is eligible to claim them, or they lose certain stuff.
Yeah,
if
we're going to get into that.
So you can't just do an analysis to figure out who's best to claim this person on a tax return. It's pretty cut and dry. Who can claim them? If the parents can, they must.
Right.
If the parents can't, then the child can.
Right. So when you're talking about giving stuff up, so if the parents claim the child, they get some sort of child tax credit or the family tax credit, depending on the situation. And so a lot of times if it's a college kid, the parents would be giving up that $500 credit, family tax credit. And of course, the education credits are big. So whoever claims the dependent gets the education credits, with one exception. If the child is eligible to be claimed by the parents, but the parents choose not to, the child cannot take any of the refundable education credits, which I know this is confusing and I can't squeeze it into it.
No, it makes sense to me because I was just working on this with a friend, and I want to bring that topic back.
Okay.
Ask that specific question because I think a lot of people are finding themselves right there, and I want you to restate what you said. And then we're also going to talk about kids making money and how that works. So that and more coming up on the Wise Money Show with Korhorn Financial Group. All right, really, really short break.
Do we get to hear what the 18-year-old did to earn all this money? More than mom and...
I know.
Do we know that whole story?
Our one fan of the show. I hope you're watching. Tell us how much, or tell us what your child did to earn all this money. No, probably. Let me talk like a youngster. Probably YOLOing some NFTs, something.
Wow.
You only live once trading. And so that
I'm still going to the old staples of YouTube or TikTok.
Okay. Yeah, maybe. All right, let's get into it. I want to pick up that, and then this is third segment. So let's pick that up, and then maybe we can get into kids earning money, like college kids or meme stocks or whatever, and how that works. So we'll go into kitty tax and that sort of stuff. This is definitely going to go into the fourth segment as well.
Yeah.
Like, we won't get to listener questions, I don't think. All right, here we go. Okay, so your child is possibly a dependent, possibly not. You're looking at the rules, but if you claim your child, you don't get the college credits. But if they claim themselves, do they get them? Ooh, we are talking about that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFG studios, Joshua Gregory, and then Ryan Fair is a CPA and a CFP, and he just thought through all of the mistakes that I made even making the introduction. There's all sorts of errors in my thinking, but that's how normally we think about it. Well, who wants to take this deduction? Where is it better? But the rules, we're explaining them to you right now. Every episode of the Wise Money Show is on the YouTube channel. Go check it out. You can engage with us that way, leave questions and everything. You can do so. Search the Wise Money Show. All right, Ryan, so here it is. The American Opportunity Credit, okay, the AOC is
AOTC. Come on now.
Sure, if you want. The American Opportunity Tax Credit, I get on a soapbox because in all of our years of doing this, they've never changed these phase-out thresholds. Squeezing the middle class. It's squeezing the middle class. So here's the thing. If you're a married couple, let's just say that, and you've got a college-age student, then as long as your income's below, what, 165, something like that, then you get this American Opportunity Tax Credit of 100% of the first $2,000 spent on tuition and 25% of the next $2,000 spent on tuition. So you spend $4,000 on tuition, get $2,500 in a tax credit. But what if your income's above that 165? Then that starts phasing out. And if your income's above 185, it's gone. So your income's above 185, your child student worked part-time and made $5,000. Well, you don't get this tax credit, so should they just claim themselves and take the credit?
Unfortunately, no, Mike. So the child, if they did claim themselves, which they really couldn't if they're making $5,000 to their earnings because they didn't provide over half the support. However, the IRS has already thought through that same situation where first the child would have no taxable income if they made $5,000 or $10,000 because the standard deduction would erase all of that. So we were talking about the $12,550 of standard deduction. So that would erase it. So the kid would already have no federal income tax liability, but they do not allow any refundable American Opportunity Tax Credit in that situation. So that's where you can't get additional money back
That's a complicated concept, and these tax credits that you're describing. Remember, a tax credit, we always talk about it being one of our favorite parts of a tax return because a tax credit erases actual taxes owed, right? But if you don't owe any taxes, then there's nothing to erase. And that's when we start looking to, okay, are these tax credits capable of creating refunds? So there are some credits out there that even if you owe no taxes, they will just give you money, essentially. But this isn't one of those. And so if you've already taken your tax bill down to zero, there's really no economic value to even receiving this college credit.
For parents,
there is
the child,
refundable American Opportunity Tax Credit unless they're phased out, like Mike said. Their income is too high. They're not eligible for any credit. But for the parents, if they're making $100,000, a portion of that is refundable where they could actually get money back even above and beyond. So let's change it up a little bit and say that the parents make too much, can't claim the kid. The kid makes $20,000. So parents are not eligible for the American Opportunity Tax Credit. The child, if they've got $20,000 of income, would reduce that by the $12,550 standard deduction. So let's say there's $8,000 left of taxable income. Then they would have tax. They would be liable for tax on that $8,000. Then the American Opportunity Tax Credit could be used to erase that liability on the $8,000.
Take them down to zero, but as you said, not
beyond.
into negative territory where they're getting a refund because of it.
In that scenario, for those of you following along with numbers, that'd be 10% tax bracket, so $800, and that $2,500 potential tax credit, they'd only use $800 of it.
Right.
So, and the parents would lose out on a $500 tax credit.
Yep.
So
that's
they would
painful.
be giving up $500 for the family tax credit.
I mean, but I don't blame you if you've been thinking about this. I don't blame you because this frustrates me. There's all this discussion about student loan crisis and college getting so expensive, blah blah blah, and yet we've got this tax credit that's there to help the middle class, and they've never adjusted these bands. What's it been? Over 10 years?
Yeah, it's a long time.
And they've never adjused these bands, and so anyway. All right, let's talk about these kids making money. Specifically, do you have a job for Easton? No. So let's just because it's interesting, we live in a college town. Let's talk. College athletes can get paid now. What's going on with that?
So this hot new thing this year is the NIL, so name, image, and likeness. So the NCAA came out and said, okay, we will finally allow student athletes to get paid for their name, image, likeness. So before this all happened, it was illegal for student athletes to charge fans for autographs or, get free sandwiches because they're a student athlete. That was taking advantage of their...
Unless you go to Ohio State, right?
Well, yeah, everything goes there.
And then you get caught, and then you're in trouble, and the coach leaves. But then they've got another great coach right behind them, and they're fine.
No kidding. Yeah.
Golly.
Yeah, we're worried about sandwiches around here. They get cars and everything else. So basically, NCAA allowed kids to do this. So lots of examples. So they can monetize, student athletes can now monetize like their YouTube channels and get paid for people following them because of their name, image, and likeness. Mm-hmm. They get paid for that stuff. They can teach camps to students or to kids and get paid for that.
Which is, by the way, so I was, no celebrity by any means, but I played college hockey, and everyone teaches camps. That's what I did. That's you did that in the spring outside of season. You did it in the summer.
Did you get paid for it?
I got.
It was basically a part-time job.
It was
for
a
you,
job.
Right?
Huh. Yeah. So was I not supposed to?
Yeah, your team just voided all of their wins.
That wasn't any good.
All eligibility in the NCAA now.
So I already hit on, signing autographs and stuff like that. Doing commercials. You've never seen college kids in commercials because that wasn't allowed. They weren't allowed to monetize that. Mm-hmm. So example around here, obviously we're in Notre Dame territory, just down the street. One of the funny endorsements that I saw come out of this, not funny if you're a lineman, but awesome if you're a lineman. The offensive line of Notre Dame is now sponsored by Mission Barbecue.
Really?
That's awesome.
They are the official sponsor of the Notre Dame offensive line.
I love both of those things. Yes. Mission Barbecue and our offensive line.
Yeah.
Love it.
So they literally are benefiting from their status as a Notre Dame offensive lineman.
Oh, that's cool.
They're getting paid in the form of barbecue.
Heck yeah. I like it.
Oh, so it's not cash. They're just getting free food?
No, I think they probably are getting some cash also, but I'm sure free food's a big part of it, and they can the kids get endorsed or the students get paid to endorse Mission Barbecue on their social media, stuff like that.
So
pretty cool.
there's a lot to hit with this, and we're running out of time. But so if your student happens to be, if your child happens to be one of these benefactors, what was it? Bryce Young is like over $1 million bucks, and I mean, it just in the first week he earned it. Like he had all of that before even the first week, and it's like this dude's never even started a game. Okay, he earned it. Okay, he's okay. But taxes, so you got to start thinking financial responsibility for these young kids who have no experience and have no skills handling money. And so I think about taxes, and I think about being a good steward of these resources. And so even though we're focusing on tax questions today, I don't want to lose sight of comprehensive financial planning. That's the big idea. And as your college-age student, if they start making money, whether that's meme stocks, whether it's trading, whether it's getting some endorsements, making sure you connect them with the CFP and have them start planning. So, all right. Well, we've got more tax questions coming up with Ryan Fair and the rest of us here. Coming up, we got more. Oh, my goodness. You're going to have to cut that in.
And more. And more and more.
All right. So here we go. More coming up here on the Wise Money Show with Korhorn Financial Group. Sorry, that is funny.
That needs to be preserved
There was
in the bank of bloopers.
Yep. Recycle.
She might leave it in there.
We have to cut in for a WFRN. That's why I was saying don't say anything. Don't if you wanted to interrupt because we had to pause there. So, all right, I want to pick that back up because we never talked about kiddie tax.
Yeah,
and I don't know. I do think there's I think there's more to talk about here. So we've got 13 minutes this last segment. Will it be all Josh and I asking you questions? Probably. But if not, I'll pull up the question bank. But my guess is there's enough questions still here. So, all right. Ready? You made note of that? Mm-hmm. Yeah, geez. That's a first. But
Season 7.
I know. Here we go. Oh. Yeah. Okay. Okay, so your dependent child has some investments. That's sort of been the trend over the past 2 years. They've set up a Robinhood account and they bought Bitcoin and sold it. Do they have to pay tax on that? How's that work? We're talking about that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here, friends. My name is Mike Bernard. Here with me in the KFG studios, Josh Gregory and special guest CPA Ryan Fair. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media. Search the Wise Money Show and follow us there. Okay, so Ryan, we were talking about the student athletes now getting paid. They can get paid for autographs. They can get endorsed. They can start a business, and that's all legal. Now, the way I understood this, because we've got some friends at Notre Dame, and I was connecting like, hey, do you guys want to talk through this? And they're still sorting it all out and being very careful because this is a sticky situation, and you've got kids' lives caught here. Like I see it that for all these years, their talent has allowed universities to make money and retailers to make money and restaurants to make money, and yet many of them have struggled to make anything, right? Mm-hmm. So I get that side. But there is, the universities are not paying these kids. And I think that's where some people expect the conversation to go next. Is university, you're providing in many cases for scholarship athletes, you're providing free education, but you're not paying them, and yet university, you are receiving more money because of these athletes, and we'll see if the NCAA has to fight that battle too.
Oh, they will.
Yeah, I expect that as well. All right, so let's shift gears because it's a similar situation. Let's talk about the kiddie tax, Ryan. Can you explain what the kiddie tax is, and then we'll get into some scenarios?
Yeah, so basically the kiddie tax is the IRS's way of taxing investment or non-earned income by children. So a lot of times parents will think, hey, can I just shift a bunch of money to my kids, pay their, they earn the investment income at a lower tax bracket than me, and then go on our merry way. So the IRS has thought through that, of course, and they've come up with these rules called kiddie tax rules. And so basically, you may just get in and explain.
Yeah, get in there.
Yeah, especially like who it applies to, what ages and everything, because kiddie, the name itself almost implies, well, these are like 5-year-olds, right?
Yeah, no. So basically, any dependent children is what it's referring to. So earlier in the show, we talked about the dependency rules, under age 19 or under age 24 and a full-time student. That's kind of the age bracket that we're talking about. So yeah, could be a college kid, could be a high school kid, could be a toddler. And it's all based on non-earned income. So investment, think dividends, interest, capital gains. Those are the biggies that we're talking about when we're talking about
not talking about paycheck money.
Correct.
Or side business money, that sort of thing.
Right. Yep. So yeah, with the kiddie tax, basically the first $1,100 of, well, first let's go back to the standard deduction. So we just spent a bunch of the early part of the show talking about the standard deduction being $12,550. Not the case for investment income. So that standard deduction is the child's earned income plus $350. So if we're talking no earned income and just investment income, there's basically no standard deduction
for kids.
For
For those of you who are like, whoa, are you serious? I'm about to retire or something like that. No, that's
different set of rules.
Yeah, isn't it crazy? Man.
Yeah. So yeah, we're specifically talking about kids' investment income in this situation. So let's say the kids have a bunch of dividends or capital gain income. They sold some stock. The first $1,100 of that income is tax-free for the kid. The next $11,000 is taxed at the
$1,100.
I'm sorry, yeah, $1,100 of investment income is taxed at the child's tax bracket, which most likely would be the 10% bracket. Anything above, so we talked $1,100, anything above $2,200 is all taxed at the parents' tax rates.
So
their highest tax bracket, right? Their marginal rate.
So it's treated just like any of those investment earnings above $2,200 were slapped on the parent's tax return.
So does that mean that income, the kid's return gets done first and that income shifts over to mom and dad's return? Or is it no, mom and dad's return gets done first to find out what tax bracket they're in, and then that carries on to the kid's return?
Yeah, typically the parent's return has to be done first because you have to know what the rates are going to be used. So there's two different ways the IRS has set up where you can actually do it without doing the kid's tax return, just purely doing it. There's an additional form that you put the kid's investment income on the parent's return, or you have to, it depends if it's too big of a number of investment income, the child has to actually prepare their own tax return. There's a different form that you kind of import or include the parent's taxable income and all of that stuff to figure the rates.
I feel like the message in all of that is it's another reason why it's important to coordinate parents and children's tax returns.
Yep, absolutely.
I mean, how often throughout the years has the child, maybe off at school or something, gone and done their own return, independent, on their own, and then the parents go to do their return, and there's something messed up, like they weren't coordinated well.
Yep.
And kiddie tax is an example that you hope to avoid anyway, but
of course.
It's just another reason why probably whoever's preparing one return should be preparing the other returns as well.
Well, I mean, oftentimes the kid's away at college and they jump on TurboTax because their roommate told them, hey, I just got my tax refund. And the kid's like, I want to do it. And they select that they're their own dependent.
Yep, all the time.
And
so then we finish the parent's tax return and, of course, claim the dependent child that they're entitled to claim. IRS rejects it when we e-file it because someone else has already claimed the Social Security number as a dependent.
As a dependent.
And there's no easy way to resolve that. You have to parents have to paper file their tax return instead of e-file. It takes longer for processing and blah, blah, blah.
Yeah, this whole kiddie tax, if you're wondering, well, why in the world does something like that even exist? It's because in the past, very wealthy families would shift assets around or shift income around to let it land on the cheapest tax return possible. And if you own some stock that's really run up in value, and if you're going to cash it in and really pay an arm and a leg, you might be tempted to shift some of those shares into a son or daughter's name, let them cash it in and pay a lower tax. But that would be unearned income. It's not paycheck money, so it falls under these rules of kiddie tax.
But should you do that if there's $2,000 or $3,000? I mean, there's still a little bit of benefit. Are families doing that these days? Is this a viable tax strategy, or is this such a small amount that you'd say, nah, don't do it?
I mean, for me, it's such a small amount that I don't think the benefits are really worth it. I mean, so you would have $1,100 of income that would be completely tax-free. The next $1,100 would be, 10% or possibly 0% if it's long-term capital gains. So basically, you're talking about up to $2,200 of tax-free income, which of course that's good, but
you also have to pay attention to, depending on what age these children are you getting in and messing potentially with some financial aid issues, that sort of thing, by putting income in their name? It's treated less favorably than the parents' income. So it is complicated, and don't think, hey, I found a loophole here. Right. The point, though, is the shifting of income around and finding the ways to pay as little tax as possible. That is a financial planning story problem.
Yeah,
right?
That's right.
It's why the investment decisions that you make are going to have an impact on your tax picture and vice versa. And so you don't want to make any of these decisions in a vacuum. It's important to make these decisions, to uncover these strategies as part of a financial plan, not just a tax avoidance type of scheme.
Right. So you've got a dependent child who's got enough income to file a tax return, but they've got earned income, but they've also got unearned income.
Yep.
But as long as they're dependent on someone else, that standard deduction only will go against the earned income?
Yep. So earned income plus $350 is the new standard deduction.
Why
for that
$350?
I have no idea.
Is that just kind of an assumed amount of interest that someone might actually earn?
I'd love to earn $350.
I know. That was before today's interest rates.
Yeah.
Okay, so we're talking about this the reason why the laws are there, and I don't know why, but I just that always helps me, because when I can't understand why they give this extra $350, it infuriates me. When I can't understand why they increased phase out limits for everything except for these college tax credits, and yet they complain and want to do all this student loan forgiveness, that just drives me nuts. I don't understand.
Yep.
But the reason for this kiddie tax is that they're trying to close this loophole of wealthy parents just gifting money to kids and having the kids sell it at a lower tax bracket. But seriously, what if a kid has a Robinhood account and they've been speculating and been lucky, and so they've got profits? Like, if it's legitimately the child doing some investing,
exactly,
is there a way to legitimatize and say, no, guys, listen, there's no kiddie tax situation. This was me.
Welcome to adulthood, kid. You get to pay taxes on those earnings. I mean,
it's not fair. It's not a fair system.
Yep, yeah. It is what it is, though.
Yeah.
Hey, can I interject a question too? Because if we're talking about trends and things like that, it feels to me like today's youngest generations, they almost seem to have a bias towards the side hustle. Like I even look at my own kids, and they're constantly thinking about, okay, what kind of business could I get going, or how could I go make some money? And I mean, they're not even old enough to go get a job, but they're already thinking about a business. So a lot of these kids that have some sort of a side business, or they found a way to make some money, are you seeing more examples of that as a tax preparer who sees a lot of returns and everything? And if so, what are some of the things that maybe they might be surprised by? I'm thinking about self-employment tax and things that it's not like anyone's ever sat you down and explained, hey, don't lose sight of this.
Right. I wouldn't say we're seeing a ton of that, but
Because they're not telling you.
exactly. That's what I was going to say. So as you coach your kids to start out their business, we really don't see a ton of that. Of course we see college or slightly out of college in that age group. Of course, they're starting businesses and getting a bad wake-up call to the self-employment tax situation, but not with minor young children. We don't see it much.
And self-employment tax, at any age that can be a surprise, right?
Yeah.
Where it's both sides of FICA and there's no withholding against it on your profits, on your business income. So, all right, thanks, Ryan. This is helpful. Next week, Ryan will be back talking about taxes when you're selling your house. But that's all the time we have for today. On behalf of Josh Gregory, Ryan Fair, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.